the built-in gains tax. We've mentioned a few things so far about how there are concerns, let's call them concerns, from the IRS about individuals electing to have their C-corp become an S-corp in order to avoid certain taxes. And that's a big no-no because we don't try to avoid taxes. We're going to pay the IRS as much as they want. Of course we are. So another consideration is the built-in gains tax. And this, again, is similar to kind of what we talked about. This is a special tax imposed on S-corps that were previously C corporations and had net unrealized built-in gains in their assets at the time of the S-corp election. I'm just going to give you, we have other examples, we'll talk about it more, but just so you have an idea. If I was a C-corp, I sold an asset at a gain, whether it's a machine or stocks, whatever it is, it can be any asset. I sold it for a gain of $10,000. The C corporation would have to pay tax on that, and then we would have profits from that. Those profits would be given to shareholders who have to pay tax on that. However, let's say I'm holding an asset, I become an S-corp, and all the while it was appreciating while I was a C-corp. As such, once I'm an S-corp, I don't have to pay tax on that in theory, but we have this built-in gains tax, which is essentially kind of like a clawback. It's the IRS is clawing back any amount that appreciated while it was a C-corp. Because again, the concern here is that you're electing to become an S-corp to avoid that double taxation, which you are electing to avoid that double taxation. However, while you're a C-corp, you didn't make that election yet. So you have to be taxed as a C-corp there. The purpose here is to prevent corporations from avoiding the double taxation on appreciated assets that would have been subject to tax at the corporate and shareholder level if the corporation had remained a C corporation. Now, the big tax, it's imposed at the corporate level and applies if the S-corp sells or disposes of assets with built-in gains within the 5-year recognition period, which begins on the date of the S-corp election. The tax rate for the built-in gains tax is the highest corporate tax rate in effect at the time of the asset's sale or disposition. So you got to pay tax at that rate. Here is a wonderful example, because I know I like to give examples and then we on my own, and then we have examples that I put in here with slides, but I love examples. We are demonstrating how this all works for you. Now, suppose Mountain Inc., a C corporation, has an asset with a fair market value of $300,000 and an adjusted basis of $150,000 on the date of its S-corp election. So as of right now, this asset has a net unrealized built-in gain of $150,000. Right now, we let's say it's day one of being an S-corp. But right now, we've got $150,000 of gain that we are going to have to pay tax on, or let's say we sold it today, we'd have to pay tax on the gain of $150,000. Now we're getting into S-corp territory, and we'll see how this all works. Now let's assume that Mountain Inc. sells the asset for $320,000 within the 5-year recognition period after making the S-corp election. So it's within that. If we're past that, we're not going to worry about this. The actual gain realized in the sale is going to be that current fair market value, the selling price, minus the original adjusted basis, which is $170. Now, this big tax will apply only to the lesser of the actual gain realized or the net unrealized built-in gain at the time of the S-corp election. In this case, it's going to apply to that built-in gain, and there we go. That is $150. Assuming the highest corporate tax rate is 21%, the built-in gains tax liability would be this amount, $150,000, times the corporate tax rate gives you your tax on it. Now, the rule is the highest corporate tax rate, and if that rate currently, when you're taking the exam is 21%, which it likely will be, use that amount. If not, use whatever it gets changed to. Mountain Inc. would be required to pay the $31,500, in built-in gains tax at the corporate level, and the remaining income would pass through to the shareholders who would report the income on their individual tax returns, just like they would an S-corp, right? It doesn't really affect them at that point. They're just paying tax there. I mean, yes, there is a reduced gain on this because you presumably had a gain of $170. That gets reduced by the $31,000. It's important to note that the built-in gains tax does not apply to assets acquired after the S-corp election, and it does not apply if the asset is sold or disposed of after the 5-year recognition period. Think of this as kind of the statute of limitations. If you're holding the asset longer than that, you're not going to have to worry about this built-in gains tax. We kind of talked about that a little bit as well. Gotta love these examples. Great way to demonstrate what the heck is actually going on. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.